All right, so let's get started with this. We'll start off just by saying that we think most firms have a pretty, not standard life cycle, but there's a common path that we kind of see firms take, let's say, especially if we start talking about big firms. And of course, firms don't start big, right? All firms start small and they get big, but we're not focused on like little mom and pop shops when we talk about raising money in this chapter. We're focused on big corporations, right? Because this is intermediate corporate finance. So of course we're focused on these large corporations and the fact they're going to need to raise money. But we do know that most firms don't actually start like that. They start off as a sole proprietorship, or they can start as, if they have, of course, multiple people, a partnership. But that eventually the funds of the founders and any friends and family they have are not enough, right? It's one thing if you just want to own like a little lifestyle business or just a little moderate growth business, if you want to open up a nail salon or a construction firm or something. But if we start talking about these companies that become very, very large, they run out of money pretty quick. And so they need other investors, right? And so that's when we see most of these guys become some type of corporation, right? Standard corporations, and we have things like LLCs and S-corps, those kind of hybrid forms of business that, again, if you're a very large firm, that they're not going to allow you to be that, right? They're not going to allow Walmart to be an S-corps and get the benefits of an S-corps. So most of our very large firms are going to end up being corporations. Now, that doesn't mean they'll be a public corporation, but they will be a corporation, right? We have private and we have public corporations, which I know have already come up many times in the past, right? I use HEB as our local example of a very large private corporation that everyone here knows about because you guys all shop at HEB because it's a sin not to. And the SEC is going to play a role regardless of if you're public or private. And so if you're under the impression that you only have to deal with the SEC if you're a publicly traded firm and you have to like report to them and file financial statements with them and abide by their rules and regulations, no. They also regulate private companies. All right, so even if you're a private company, you're going to still be dealing with the SEC. You're not going to be able to avoid it, kind of thing. And we do mean the Securities and Exchange Commission, right? Not the Southeastern Conference, the better SEC. So yeah, SEC is going to play a big role throughout all of this. They're going to be the ones setting the rules and regulations for companies and how they can raise funds and the rules they have to follow when doing so. The SEC also regulates individual traders, right? It regulates the trading activities of individuals, things like insider trading and margin requirements, right? Full disclosure, all that sort of stuff. And so they play on both sides of the field here, both on the side of the companies that are raising the money and the investors that are contributing the capital to these firms. Now, we can have what's called, before we get into our public offerings, we can have what's called a private placement. It says a private placement is the sale of stock to only one or a few investors, usually institutional investors. Those investors typically have to be what's called accredited. Or it's like you have to be either accredited or qualified. And there's certain wording with it. And basically you either have to be rich or you have to have some type of insider knowledge of the firm. So like if you're a high ranking manager, in that like corporate suite kind of thing, you can also be a qualified investor. If you have a lot of assets and you are a, informed investor who has a lot of assets and everything, there's all kind of different specifications for this. It's pretty easy to find if you're ever curious. It's not that hard to become accredited if you have a decent amount of money, kind of thing. And when I say decent amount, I think it's like $100,000 of assets or so. So it's not like you have to be a billionaire type thing. But it says an accredited investor are just the officers and directors of a privately held company, or they can be high wealth individuals, or they can be institutional investors. So pension funds, endowment funds, those sorts of things. It says who are allowed to purchase securities in a non-registered private placement, but they cannot subsequently sell their securities in the secondary market to the general public. All right, so this would be like HEB investors. They can't just go start selling their stock to just us normal plebeians kind of thing. They can have a certain number sometimes of unaccredited investors, but it's pretty limited. It's only 35 non-accredited, basically. So there's all of these regulations that say how much money you can raise through a private placement from different types of investors. So like I said, you're not avoiding the SEC. You're going to still be dealing with them and all these different issues that you're going to want lawyers for. Biggest thing to know with private placement, of course, we'll talk about some benefits about it and some disadvantages to it later. But the biggest thing is it's private. You don't have the scrutiny of the market, right? And that's why sometimes companies actually go from public to private, is they don't want to do things with the market scrutiny on them, right? If I got to chop off someone's leg, I'd rather do that in private. I don't want the market scrutinizing how I'm chopping off someone's leg. Apply that to a company. And so a lot of times when companies want to restructure, like divisions or something like that, or do a major just restructuring of the firm, and they don't want the scrutiny of the market, they may go back private. Biggest downside, liquidity, right? This whole part right here where I can't sell my stock in the secondary market. Yeah, that's an issue. But private placements are a thing. It'll come back up later in the chapter. Now, often associated with a firm being private is also having the presence of both angels and venture capitalists. So what's the difference, right? Because a lot of times we kind of use those terms, we kind of slam them together. I know in entrepreneurship, we focus a lot on what's the difference between them. So I'll give you the short version. It says an angel investor is a wealthy individual investor providing early external financing for a startup company by purchasing equity. Okay, so typically angels come first. They make smaller investments than VCs because it is their individual wealth. And these guys are going to want to be diversified likely. And so they're having to take their individual wealth and split it up into different firms. And so they usually tap out way before you hit $1 million of investment. Your book says for this one, 50,000 to 400,000. You don't need to remember the exact numbers. Just know they make smaller investments in VCs because it's their money. Typically, they have an interest in making the firm successful. It's like they have some type of actual passion for the firm and wanting to see the firm succeed. They're like kind of the softer, kinder, warmer version of private equity financing. So like, let's say that I'm just a dude that has a lot of money and I would love for there to be in my neighborhood a bagel shop that is GMO friendly. I don't even know what that means, but whatever. And I'm like, hey, I see this entrepreneur that wants to do that. And I would love to have a bagel shop like that. So, let me help this guy out. Now, I still want to return a high one because I'm taking on a lot of risk. But like I said, they often have some personal interest and they want to see the business be successful. And eventually they get priced out a lot of times. If the firm starts growing too quickly and they can only invest so much money, they kind of end up going like, I don't have enough money to do this anymore. That's where VCs come in. So you have your venture capital fund. It says a private limited partnership, which typically raises cash from a relatively small group of primarily institutional investors. So again, things like pension funds, endowment funds, and then purchases equity in startup companies. A venture capitalist, it's kind of a similar definition. The manager of a venture capital fund, the fund raises most of its capital from institutional investors and invests in startup companies in exchange for equity. So angels get equity too. VCs also get equity. This is Shark Tank, basically, right? That the shark may be an individual investor, like an angel, or they could have their own venture capital fund that they are the manager of. Venture capital fund, think of it more like if an angel is an individual, can't spell today. These guys are firms. And so they can contribute larger amounts. They come later in the financing, and they often will help a firm go public. So it's like the angel helps you become established. The VC helps you get huge and become a public firm, do an IPO or get bought by someone, that sort of thing. They're going to typically want a seat on the board. They're going to be involved heavily with the high level decisions, and they often specialize in certain industries. So, they may specialize in technology or in healthcare or real estate or whatever, right? That they have an expertise, that they feel that they can bring some expertise to that board of directors. Still want a very high return because they're taking on a lot of risk. But like I said, they're kind of more formal. It's a group contributing, pooling money together so they can invest larger amounts. And like I said, they typically come after angels. And so that's how, in my mind at least, I've broken it down over the years. And it kind of makes sense, that difference between angels and VCs.